The U.S. debt ceiling it's just once again being debated in U.S. Congress. This time it's part of Biden's 2024 budget. This is almost uniquely an American issue, as the only other country that has a nominal debt limit, so a set dollar value, is Denmark. And the Danes, they normally raise it well in advance of even approaching the limit. Last time they were about 2/3 of their limit when they raised it, and that was the highest it's ever been. So this is uniquely an American issue. And it's not the first time, like Ryan was saying. The debt ceiling has been raised over 90 times historically, but since the great financial crisis, it's been more contentious among policymakers. And frankly, if you don't know, the debt ceiling is simply just how much the US Treasury can have outstanding of their debt. So all your Treasury bills, bonds, and all that, that's how much they're issuing. If the debt ceiling is breached, the US Treasury is unable to issue more debt, and therefore they're unable to pay government bills for Medicare, Social Security, and also unable to roll its existing debt, amongst other things, which would in turn freeze or at least hinder many government operations. The U.S. debt ceiling for the U.S. debt ceiling is currently about $31.4 trillion. For size comparison, the U.S. GDP is expected for 2023 to be about $23.6 trillion. The equity markets have not reacted to the shifts in the news and opinions of policymakers. Really, day to day, you'll see a bit of an influx. So in a day which you'll see, they're going to pass this bill, which will allow a debt ceiling to be raised. The markets might rally a bit, but then the next day it'll give back. It hasn't been a sustained shift. However, on the fixed income side, we have seen a significant shift. So we saw a significant shift about at the start of May compared to about mid-April of the 1 month T-bills shifting to about 5.5% from about 4.5 to 4.75 in that range, depending on the exact maturity date. And yields have stayed elevated since. So you're seeing about a 75 to 100 basis points uplift just in default risk over the last month. So another way we can look at these events in referring to the default rate is CDSs, or credit default swaps, which is effectively insurance for bonds or a T-bill if it defaults. In the following graph, CDS premiums, so what you're paying, have seen a massive spike to 160 to 100 basis points depending on the day, up from 20 to 40 basis points prior to the debt ceiling being put on center stage. Again, for our listeners, the graph is effectively just a straight up line. And it's, as well, this is an all-time high since 2008. And it is substantially above it. And in 2008, we were seeing the 5-year being higher, versus this time we're seeing the 1 year as well as lower maturity, so your 1 month, but this graph doesn't display that. So we can also use those premiums to derive the market's implied probability of defaulting, so the chance that the government will default on an event according to the market prices, which right now is about 3.5% to 4%. So you're seeing Treasury bills having a chance of defaulting in the next year for the 1 years of 3.5% to 4%, compared to the 2011 and 2013 debt crisis. Like Ryan was saying, and I've said, this is not the first time this has happened. 2011, which was the most severe, peaked around 6% chance default. And just for context, the 2011 ceiling was raised 2 days before the expected X date, which is the date when treasuries can no longer issue debt. And the X date does move. It's really a best guess. And it's never really, until it would happen, you wouldn't know the exact time. And in 2013, the government passed the Continuing Appropriations Act to extend the timeline before the debt default and effectively ended the crisis, as they were eventually able to reach a deal. And that was about 4% then, so about where we are now. If you're wondering why the default chance is notably lower than in the 2011, yet the premiums are higher, it's because yields are currently much higher as a result of interest rates, which in turn increases the CDS premiums as the securities trade at greater discounts, which increase the value at risk for the treasury holders. So default risk, it is currently lower than the 2011, but the premium is higher. So really, what does all this mean for investors? I probably lost half of you already running through CDSs and treasuries, but it is a big deal if this does occur. I should really stress that this could be a massive impending crisis if it were to occur. However, if a deal is unable to be reached and the US defaults on its obligations and payments in the real world, we would see significant and far-reaching effects. According to the CEA, the council who advises the president on these matters, immediately following a default, day-to-day operations would shut down, the US credit rating would fall into restricted default or RD for Fitch ratings, with individual treasuries that do default going into D rating or default rating. In the real economy, the decline of GDP would occur significantly, with immediate expected loss of jobs about 2 million. 2 million jobs lost just by them not passing this. As well, it would likely increase borrowing rates over the long term, as the faith in the US government will be lost. You see a rating decrease from the rating agencies, which potentially weaken the dollar's hegemony worldwide. So your dollarization in other countries would be at risk if this were to occur. But even worse, if we saw an extended default, the stock market would fall by 45% within the first quarter. This is all expected. If this does occur, don't be saying it didn't fall by 45%. This is best estimates by the CEA. And 8 million jobs would be lost. You would see any credit cards, loans, mortgage, interest rates, all that would skyrocket to unprecedented levels. So if you think your mortgage has gone up a lot so far, if this were to happen, this would be peanuts in comparison. The US would fall into a deep recession, as the real economy of the US will be severely weakened. Any credit markets and credit margins are weakened as well. This would devastate not just the US, but most likely the world economy, especially ones that are deeply connected to the US, like Canada. Not exactly a positive note to end on, but I'll open that up to you guys.
I guess we should just say they better get it done, right?
Yeah.
That's what we better say.
Yeah, it really is.
I mean, we would expect, but yeah, it does have dire consequences if it is not if they don't get that done. It's one of those,
it's one of those times you're hoping it's political theater and not an actual case of them disagreeing, which I'm fingers crossed most time it is.
Yeah, I mean, from when I've observed this for years and years and years now, it is a lot of political theater, people trying to score points, and in the end, if it isn't done, you just went over, you listed a number of things that would occur or could occur if this is not raised, that ceiling. That it makes it impossible for them not to at some point. So
exactly.
We would expect, given the stakes, that it will be.
Yeah, this is why. No,
and I gotta say, because Aaron isn't disputing that he recalls when it was passed in 1917. Are you disputing it, Aaron? Your silence incriminates you. So clearly you do remember hearing this pass at that time.
I was going to add to, I was just reading a JP Morgan article here, and they say basically since World War II, the ceiling has been raised or suspended about 102 times, which the last was in 2021. And generally, looking at how the market responds to these debt ceiling episodes, we did see, I guess, the S&P 500. I think this was one of the larger declines. The S&P 500 moved from, I believe, about 1,300 to coming all the way down to about 1,100, right as they were kind of going through this episode. But generally, JP Morgan makes comments here that outside of 2011, realistically, the volatility around the debt ceiling drama is usually short-lived. So usually we see the market recover quite rapidly, but that's as long as they come to some sort of conclusion.
And just in context as well, that was the U.S. actually received a rating downgrade on their securities.
Mm-hmm. That's a great point.
So that was the first time that they happened. They were, I believe, AAA before. Now they're AA, if I remember correctly. I will put it up if I am wrong. So
I believe it was certainly a different and singular moment in time when at that time when it happened. It was the backs of the economic crisis, and but a different time than we would expect them to be able to increase the ceiling this time once again, as we've seen many times in the past. But it is a good discussion point, and it's certainly topical in the markets this week.
Yep.